So let's take a look at differential analysis and product pricing. So all differential analysis really means is that we are going to analyze the difference between two different choices using our accounting skills, okay? And they always get laid out in the same way. And so I'll show you there's kind of a pattern. And so typically what we're saying is like, you know, it's usually a choice, like, do I want to continue to buy this from a supplier, or do I think I could make this product myself? And then we're comparing the two side by side to see which would be a better thing for us, okay? Actually, a fair amount of business analysis is just that. Someone trying to make a decision and asking, what's better, this or this, right? And so I can't tell them all the ways, but I can tell them from an accounting standpoint what's better. But you know, sometimes in real life businesses, you have to, in fact, like here at the college, sometimes I annoy my higher ups because I'll kind of break things down this way, and they'll be like, there's more to these decisions than just the numbers. And I'm like, says the people who don't know how to do numbers. But I actually agree with them, right? There's some truth to that, especially like in small businesses. You know, numbers sometimes equal people. Like if we have to get rid of people, that's hard. And so we have to keep that in mind. Maybe it's worth it to eat a little bit of profit, not make as much profit, but keep paying our people well, or something like that. Like there's more than just the numbers. Anyway, so here, this is kind of a standard, I guess, what a differential analysis looks like. It usually just has alternative 1 in the first column, alternative 2 in the second column, and then a differential effect in the third column. So I don't know what, you know, this is just a sample one, but this is apparently a company trying to decide if they're going to add a salad bar or not, or something like that, right? So we'll look at some examples of it, but that's just sort of like, so you know, we're going to go through several different types of differential analysis. They all use the same basic format, which is usually income statement type items across the rows, and then alternative 1, alternative 2, and the difference between the two. So if you think about some of the stuff we've been doing already, it's kind of a lead into this. Oh, well, that's what I just said. It's in 3 columns. The first one is the revenues, cost, profit, etc. Second for the second alternative, and then third, the difference between the two. All right. All right. So this just describes that example I was just showing you. The differential revenue on the salad bar is $20,000 because the salad bar would increase the revenue and profit. The differential cost of the salad bar over the tables is $5,000 because the salad bar would increase costs. And then the differential effect is just the difference between the two. Okay, it really is that simple. So hopefully it's an easy chapter. So here's the types of differential analysis sort of problems you'll see in the book, and the sort of decisions we make in real life using it. You know, should I lease equipment or sell it? In other words, if I have excess equipment I'm not using, I could lease it out for other people to use, or I could just sell it off. Do I replace a building, or do I do away with it? Do I replace a piece of equipment? Do I, if I have a profit segment at the business that's not making money the way I think it should I discontinue it, or are there reasons I'm not seeing to keep it going? Selling a product at some intermediate stage or processing it further, right? If I'm an oil company, do I just sell it as crude oil, or do I pay the cost of refining it into gasoline and then selling the gasoline, which is a better deal for me? Manufacturing or purchasing needed parts. Again, do I make this? We had this conversation actually with about Arthur's mother's business, right? Her buying some of the materials she uses to make stuff. She could buy raw material and then make it, but it doesn't seem to pay. It's cheaper in the long run for her just to buy them pre-made. And so, right. Right. But if she had a big company and had like idle time where people were like sitting there not really doing much, it might pay to go ahead and buy the stuff raw and let those people who are sitting there, you know. So I mean, that's the sort of stuff that's the type of analyses we're trying to consider here. And so there's a lot of factors. All right, so here's a lease or sell example. On June 22nd of the current year, Marcus Company is considering leasing or selling the following equipment. So this gives us the cost of the equipment, the accumulated depreciation, the book value. If we lease it, we would get 160,000 revenue over 5 years. We would have expenses of $35,000 over those 5 years. If we sell it, we'll make 100 grand and we'll have to pay a 6% commission. Okay, so that's kind of the idea of how these are laid out. Recognize that the cost of the equipment is it's called a sunk cost, meaning that's money we've already spent. And so it doesn't really factor into the decision. That's really hard for people if they bought an asset and now they're selling it at a loss and they're like, oh my gosh, I took a loss. Well, really, you're not paying out any more cash by losing it, right? You're moving on and trying to figure out what's going to make you more money going forward. Now, of course, if the equipment's going to continue to make you money, you may have to consider that. So here's what our differential analysis will look like. If we lease it, we'll have revenues of 160,000, costs of 35, so a profit of 125,000 on doing that. If we sell it, we'll have revenues of 100,000, costs of 6,000. So in this case, it looks like leasing the equipment would make us more money. So that's probably where we would head. If you're a small business, like let's say my storage, which is just me and my wife, sometimes we would look at something like that and go, yeah, but with leasing it, we're going to have to maintain the relationship with the customer over the 5 years. That has an intangible cost that's hard to put a dollar figure on, but more hassle. Whereas if I sell it, I'm done with it, right? And so there's value in that too. That's why, again, the accountant can provide this information, but usually it's senior management that ultimately decides, it's worth it to me to, to just get the cash and run, or it's worth it to me to manage this relationship, especially if at the end of that 5-year lease or 6-year lease or whatever it was, we might still be able to lease it again if the equipment's in good shape. Mm-hmm. Yeah, and I will say in some businesses, what they do is they have the accountant come in and give the report, or if they even come in, you just email them the report and then they make the decision. In other businesses, they consider the accountant like part of the team. And so you prepare your report and then maybe someone else is preparing a report on the challenges, the pros and cons of it outside of the financial, and then you get together and you have a big group discussion about it and you get to help make the decision. So it just depends on the business and how they manage it. As a younger man, I would get mad when I would not get to be involved in the decision making. As I'm getting older, there's a part of me that loves being able to be like, I submitted my report and that's on you guys, right? Like, so I get both sides, but I still like to be involved personally. It helps me feel bought in, I guess. Yeah, you guys enjoy that. I'm gonna go golfing. All right, discontinue a segment or product. So here we have the Battle Creek Cereal Company. Here's their income statement, and they're trying to decide if they should get rid of Bran Flakes, right? Because Bran Flakes have an operating loss of $11,000. So maybe your first look at that would be like, let's get rid of Bran Flakes. They're terrible. And honestly, they are terrible. Okay. So here's what a differential analysis would look like. It would have option 1 or alternative 1, continue the Bran Flakes. If we do that, we lose the revenue, we lose the variable cost, and we lose the fixed cost. So we lose it all. But if we discontinue it, we're still going to have the fixed costs. And again, you have to read the problems carefully because it'll tell you, oh, this part of the fixed cost won't go away or something like that. And we've already kind of looked at some other problems that are like that. So here we take, if we continue doing them, we're losing 11,000. If we discontinue them, we're losing 26,000. So even though it seems like those Bran Flakes are losing us money, they're actually covering part of our variable costs, right? And so in the end, that fixed amount that's staying if it's still going to be there, we should probably continue the Bran Flakes or consider something else. Like, can we take the production capacity for Bran Flakes and put them toward what's making us the most, the best profit margins? And so, because we might be like, if we discontinue Bran Flakes and produce more toasted oats, is that so? But what this lets us do is it lets us first make the first decision. Okay, brand flakes aren't as evil as we thought they were. So we probably shouldn't just get rid of a product line altogether, but maybe we can start a new product line or expand an existing product line. And then we can go through this decision-making process again. Okay. Yeah, and it's not a gross profit. It's really 15,000 toward the contribution margin, right? Ultimately, which in the end impacts net profit. Make or buy, same idea. So we have an automobile manufacturer that produces instrument panels for $240. The factory currently only operates at 80% of capacity, which means we could make them ourselves without any additional cost other than the variable cost, the direct material, direct labor, etc. Okay, so our cost per unit would be 280, but we can purchase them for 240. So on our first thought, we're like, of course we're going to purchase them. But then again, we might realize some of that fixed cost is going to be there regardless of whether or not we're producing it, right? So we do a differential analysis. And again, in a problem, it will have to tell you that the fixed costs are still going to be there or whatever. So here we can see our cost to make them is 68. Our cost to buy them is actually the 240 plus the 68 and cost that would be there with either option. So in the end, it actually saves us money to make them. So we'll make them, okay? And I could show you, we could look at lots of these, but you're getting the point of what differential analysis is, which I think is what I'm trying to do right now.
It's just kind of odd to see, a product by itself that just its number is produced on a lot.
Right, and that's a real thing, a lot in business. Here's
Why are they using the negative number for like the variable cost when they
I think because they're trying to show because it's not an income statement. Okay, an income statement always shows everything positive.
Okay.
This is an internal report, and so but you'll see like on one of the guided, it's like, no, don't do them as negatives. So you're like, why? And that is, I'll tell you, that's honestly the truth with managerial accounting. You'll move from one company to another, and they do it different. One shows costs as negative, one doesn't, and that's a little frustrating. But the reason it's not rigid is because financial accounting is for outside users of the information. So there has to be this consistent format you always use. Managerial is just for inside use. So there's kind of like the company does it this way. So there's not really a better answer than that. So here's continue with or replace old equipment, the decision companies have to make all the time. So again, they compare the costs of continuing with the machine or replacing it. And they find out in this case, it's actually going to lose a little less money to go ahead and replace it. All right. So one concept or one term you'll be introduced to in this chapter, which you probably were actually introduced to in an econ class, is opportunity cost. An opportunity cost is simply the cost of making a decision, right? What you're losing out on by doing it one way rather than another. So in this case, the revenue that's foregone from an alternative, such as an asset or such as cash, would be an opportunity cost of getting rid of that asset. It's not recorded in accounting a lot of times, but they're real, okay? And that's kind of, again, you'll get managers that'll be like, not everything's about dollars, right? Because you could say an opportunity cost, think about right now, you're going to college. You're going to college because I think you think your plan is that you'll end up in a career that pays you better or has better working conditions or something over the long run, right? But right now you're giving up earning potential. I can remember when I was in school and I got out of the military, I was working at Edward Jones Investments. I'd finished my bachelor's and was working on my master's. And I had this client who had gone to work as a car salesman when he was 18. And then he'd been, promoted to like the head of sales. And then he was like the head of finance for this car dealership. And he was making like 120 grand a year now. And he was like the same age as me. And I was struggling, right, to start my business and go to school at night and raise my kids. And I remember feeling really jealous of him. Like, man, the opportunity cost of not getting started in the workforce, but instead going into the military and doing school was really high. Now though, he probably still makes that because he's at a local car, like he's not going to make much more than that there. And, and I might make about the same as him, but I have summers off. I have all these other great things, right? And so that's the idea behind opportunity cost. Recognize that there's costs involved in all decisions that you have to consider in the decision-making process. All right, I'm not going to go through the rest of these. They're all similar, okay, in their nature, process or sell. Again, that idea is like, do we process it to kerosene, or do we have kerosene and leave it there, or do we process it further to make it gasoline? So again, we're going to look at the revenue that comes from doing the different ways, the costs, and the change. Same thing. Accept business at a special price, right? Somebody comes to you and says, hey, I know your regular price is $18. Oh, well, no. So your regular price is $24, but can you make me 5,000 of your product and sell them to me for 18 bucks? And that's a decision that you need to think about. So often people are like, oh yeah, and then they end up losing money on it, right? And sometimes it's worth it, back to opportunity costs, to lose money on this deal if it's going to cement a customer relationship, which will then be profitable going forward, right? We make decisions like that all the time. And so same idea. So you're just looking at it going, if I reject the order, what's nice about these ones, if you reject, it's just zero, right? You don't get any money. If you accept the order, and so that's the difference. In this case, you take that deal. Sometimes there's costs of rejecting the order, but usually not. Usually rejecting the order just means we don't do it. You'll notice in this case, like fixed costs aren't even on there. And that's because they don't change. So anything that doesn't change between the two is considered irrelevant, and we don't include it in the analysis. All right, so shifting gears now into price setting. How do we choose what price to set for our products? So typically the book gives a bunch of information that I think is almost extraneous. We're going to talk about primarily in this chapter cost plus methods of determining pricing. There's another method, which is just like, usually it's called meeting competition. And honestly, it's like saying, I'm just going to set my price at what my competitors are at. The problem with that is, no, he's down at the end of the hall. So the problem with that is, what if my competitor has some advantages where he can set his price lower than mine, and it's going to drive me out of business, right? But there's a time to do that, but you have to make sure when you make that decision, it's a good decision, that you're not, like, being the cheapest isn't always the best, right? Sometimes if you have a better quality product, maybe you make your product in America with American labor, then you market on that basis, not trying to be the cheapest, okay? Other times, price is the thing, right? Especially if you're like me with storage units, right? Like, how do you differentiate a storage unit? There's a bunch of storage units. People like, is it a space where I can store my stuff and it's clean? And, like, maybe if I had like a more high-tech security system, I could charge a premium, or, a nicer looking facility, something like that. Or I could just be the cut rate one and say, hey, look, I'm $10 cheaper than everybody. So those are decisions we have to make in business too. So anyway, we're going to look at cost plus methods, where we say, this is my cost, and then I need to make some amount of profit over and above that cost. So that's what we mean by cost plus. So typically we take a normal selling price, which is the cost per unit plus some markup. And typically the markup is expressed as like a percentage of the cost. Like, that's usually how they do it. So I need to make 20% over my cost or something like that. So they have it broken down into steps here, which I find valuable, okay? So the first thing you have to do is estimate the total product cost. And that's going to be our direct materials, direct labor, factory overhead. That'll be our total product cost. Then we have to estimate the total selling and administrative expenses. Once we have the total cost, we divide that by the estimated units to be sold. That gives us a product cost per unit. Then we figure out our markup percentage, which is our desired profit plus the total selling and administrative expenses divided by the total product cost. And then our desired profit is the desired return times the total assets. And then finally, we determine our total markup per unit by doing the markup per unit equals the markup percentage times the product cost per unit. And then we add the cost to the markup, and that gives us our total cost for the product. Okay, so it's actually not crazy hard. It's just a process. So here's our example. So 100,000 calculators that Digital Solutions expects to produce during the year. Here's our manufacturing cost, direct materials, direct labor, factory overhead. So our total product costs are 1.5 million. We have an additional selling and administrative expense of 1,670,000. So there's our total cost, our total assets, and then our desired return. So step one, take our total product cost, add our selling and admin. Not add, sorry. We just figure out what it is, 1.7. Then we divide our product cost per unit, $15 per unit. Our markup percentage, which is our desired return, times our total assets, gives us 106. I don't know why they did 22%, should be. Oh, because then they figure out the markup percentage. Once we know it's 22%, then we find our markup per unit, which is to take the 22% times the $15 cost per unit, which is $330. Then our normal selling price then, which is the $15 cost per unit plus the $330 markup per unit, total cost of $1,830. So again, there's no crazy math here, okay? You just have to know what numbers you need to use. Target costing is similar, but instead we're trying to set, what we're doing then is setting a price, and then we're trying to adjust our costs so that we can meet, so that we can get the profit we need at that price. This usually happens in highly competitive markets, right? Like I said, meeting the competition. We don't always necessarily set our target price to be the same as competitions, but we might say we don't want to be way above them. So this is the price we want to sell at. We take a look at our costs and then say, do we have to make it, is that going to give us the profit we need at that target, or are we going to have to try to cut costs? And that's why businesses often say, we're going to, instead of manufacturing it here in Southern Arizona, we're going to find a manufacturing facility in Chihuahua across the border and see if we can do it cheaper so that we can meet this target cost. And I'll tell you, as much as we would all love to do cost plus pricing, the modern competitive environment, companies like Walmart, okay, companies like Amazon, force us to recognize that it's a way more competitive environment. There's probably someone else out there making something very similar. If it's not exactly the same, then something very similar. And so we're going to have to control costs in such a way that we can be competitive. Okay, usually. Sometimes you have a unique product, or you have a product that's place bound. My wife, she paints murals. She can charge what she wants, right? And she's in a position where she doesn't need the money to live, right? So she can just say, if you don't want to pay this much, then I won't do it. No problem. No hard feelings, right? Like this is how much I have to make on a job to make it worth it to me. And so it depends on what you're doing and your situation, how you can afford to do those costs. When we talk about target costing, the difference between our actual cost and our target cost, what we're going to have to set our cost to in order to make the right desired profit, they call drift. I don't think you need to know that much, but that's a term you might see come up. So that's what they mean, the difference between actual cost and target cost. Typically, target cost is less than the current cost. Every once in a while, you get lucky and you think this is what I would sell it at because this is my cost, and you find out the market will bear way more and you can actually drift up, but that's rare, okay? Just because we're in a competitive environment. And I find that a lot, again, with artisans, people who do service-based artwork, is they often undervalue their own time. Artists do that all the time. And so they think, I'd be willing to sell this for this much. And you're like, no. You need to sell it here. You need to have people recognize the amount of time and effort you put and energy you put into this. But they also have a market to compete against. So there's those balancing things. All right, and then one more concept for this chapter, which is the concept of a bottleneck or a constraint. Have you guys had the idea of constraints or bottlenecks in any other classes? Probably microeconomics, maybe, that's where that's come up. Okay, so a bottleneck is just a point in our manufacturing process where the demand exceeds the ability to produce. Okay, in other words, usually if you look across a company, you'll see that there is something limiting your ability to produce as much as you need to. Now, in some companies, they don't have that. They can produce as much as the market will buy, okay? But usually there's something, okay? So if we're at Freeport-McMoRan Copper and Gold Incorporated and we're mining copper, probably their biggest constraint is actually just, I would guess it's, I don't know what it is there. Because I mean, they move massive amounts of ore into a process to extract the copper from it, right? But probably the rate at which you can extract it. And at which point they have to make this decision. Do we create another extraction setup? Is it worth it? Or maybe it's how fast can we shovel it in? Do we get more trucks? Or, you know, so that's the idea behind it, okay, is you have to analyze your business and find out what are the constraints, what's slowing you down, and is it worth it to overcome that constraint? Sometimes financially, it's just not, you know, you just can't afford it. And so broadly, and some people actually study this and work in this field, broadly, this is called the theory of constraints, which is people who make decisions about strategies relating to constraints and bottlenecks in businesses. I think it's an interesting part of business. They really, if you were interested in that, you would probably major in, you know, after here in either logistics, which is that's how you get stuff from one place to another and how you make decisions about stuff and how to move it and use it, or analytics, which is the people crunching the numbers behind all of that. So it's an interesting field. So here's an example. Pridecraft Tool Company makes 3 products, product A, B, and C. They're not creative, okay? That's just what they call them. All 3 products are processed through a heat treatment operation, which hardens the steel. Their heat treatment process is operating at full capacity and is a production bottleneck. So they can only heat treat so much stuff, okay? The product unit contribution margin and the number of hours heat treatment used by each follows. So we can see product A, we make a $90 unit contribution margin, but it only takes an hour of heat treatment. Product B makes 100, but it takes 4 hours. And product C makes 120 contribution margin, but it takes 8 hours. So sometimes the way that we'll look at this, instead of just contribution margin, we'll say, what's the contribution margin per constrained unit of resource? So if heat treatment hours is our constrained unit, we can say that this one's making $90 of contribution margin per hour of heat treatment, whereas this one's making $25 per hour, and this one's making even less than that, right? So sometimes it helps us to reframe the decision in terms of what the constraint or bottleneck is. And then we can find out, even though product A makes less money, if we're at capacity and it's making more per hour of constraint, it's still the better deal for us, right? We can crank a lot more of those out as long as there's a market for those. So unit contribution margin per production bottleneck hour, 90, 25, and 15. It helps us make better decisions, okay? That's the idea behind all of this. So even though one's about price and one's about cost and the other's about bottlenecks, they're all differential in their basis. That's what kind of unites this chapter, is what's the difference between these different decisions that we're gonna have to make. All right, so we're gonna, let's see.